Have you ever wondered why prices suddenly rise everywhere, and then governments increase interest rates to stop inflation from getting completely out of control? Inflation happens when prices increase continuously, reducing purchasing power, meaning your money buys fewer goods and services than before over time. One major cause of inflation is excessive demand, when too many people try buying limited goods, pushing prices higher across markets simultaneously. Another cause is too much money circulating in the economy, making it easier for people to spend more, increasing demand rapidly. To control inflation, central banks use monetary policy tools, with interest rates being one of the most powerful methods to slow economic activity. Interest rates represent the cost of borrowing money, affecting loans, credit cards, mortgages, and overall spending behavior in the economy. When central banks raise interest rates, borrowing becomes more expensive, making people and businesses less willing to take loans and spend money. As borrowing decreases, spending slows down, reducing demand for goods and services, which helps ease upward pressure on prices. This process helps stabilize inflation because when demand drops, businesses cannot easily raise prices, forcing them to keep prices steady or even lower. For example, higher interest rates make mortgages more expensive, reducing demand for housing, which can slow down rising home prices significantly. Similarly, businesses may delay expansion plans because borrowing costs increase, leading to reduced investment and slower economic activity overall across industries. Consumers also reduce spending on non-essential goods, such as luxury items, electronics, and travel, helping decrease overall demand in the economy. Higher interest rates also encourage saving because banks offer better returns, motivating people to keep money instead of spending it immediately. When more people save and less money circulates, inflation pressure decreases, helping stabilize the overall economy gradually over time. However, raising interest rates too aggressively can slow economic growth too much, potentially leading to higher unemployment and reduced business activity. This is why central banks must carefully balance controlling inflation while maintaining economic growth and employment stability within acceptable levels. This balancing act is a core concept in macroeconomic theory, especially within Keynesian economics, which emphasizes active government intervention during economic fluctuations. Monetarist theory, on the other hand, focuses on controlling money supply as the primary method for managing inflation effectively. Both theories highlight the importance of managing economic activity to prevent extreme inflation or deep recession cycles. In real life, central banks like the Federal Reserve frequently adjust interest rates depending on inflation trends and economic conditions. For example, during high inflation periods, rates increase, while during recessions, rates are lowered to encourage spending and recovery. These decisions impact mortgages, business loans, investments, and even job opportunities, affecting millions of people across the entire economy simultaneously. Understanding interest rates helps individuals make better financial decisions, including saving, borrowing, investing, and managing personal expenses effectively. For example, higher rates may encourage saving, while lower rates might be better for taking loans and investing in opportunities. Interest rates influence stock markets as well, often causing stock prices to fall when borrowing costs increase significantly. This happens because businesses face higher costs and investors shift money into safer interest-bearing assets like bonds or savings accounts. In contrast, lower interest rates often boost stock markets, as borrowing becomes cheaper and companies invest more in growth and expansion. Therefore, interest rates play a critical role in shaping economic behavior across consumers, businesses, and governments worldwide. They act as a powerful tool to control inflation, stabilize economies, and maintain long-term financial health when used carefully and strategically. Understanding how interest rates control inflation helps you better understand economic news, financial decisions, and the forces shaping your everyday life.